Again, hello everybody, and welcome to this week's edition of Selfwealth Live, the technical analysis edition. We're here for another great week here with Jason McIntosh to my left. Hey, Jace, how are you?
Hey, Rog, I'm good. Great to be here again.
Good to hear. Good to hear. My name's Roger, and I worked for Selfwealth. I've been here for a good 4 years now. We've loved doing this show over the last almost 3 years. Now, just a bit under, but almost 3 years, Jay. So week on week, we've been here. We've been talking about the markets from a technical analysis point of view. So that's sort of the art and science of reading price charts, right? From the way we do it, obviously. And it's been a great journey. We're learning a lot, and obviously there's a lot happening in the markets once again to impact those charts at this point, as we all know. So it'd be good to get straight into it. Jace, welcome to everyone once again on the other side of the line. Thanks for being here with us for another week. If you didn't already know, what we do is we'll have a look at the Australian stock market to start off with, then followed by the US markets, then followed by the Hong Kong and China markets, and they're the three major markets we offer on the Selfwealth by Scythe platform, right? And then we will answer any general questions you have, and at the same time we'll have a look at the tickers that you put down on the live chat. So you can put down one ticker, we'll do one per person, and if we have time we can circle back afterwards within the time period that we allocate. Once again, if I draw that line in the sand, we won't go any further past that. All right, Jace, we're good to go. Let's have a look at that disclaimer, please.
Okay, just a quick word about how it all works. It's general commentary only, no personal advice. And I just pop up that disclaimer you reference, and this just goes through that. I'm also not part of Selfwealth Scythe. My business is Motion Trader. My details are up the top, licensing, general commentary, all of that. Beneath there's a Selfwealth disclaimer, same thing, licensing, general commentary, all in that little slide.
Fantastic. All right, thanks, Jace. All right, so obviously a lot happening in the world, as I've already said, but we did go into all-time high territories again after the show last week. Let's have a look at that ASX market. What's it tracking like today, Jace?
Yeah, so we'll start over here with the ASX 200, and really, really interesting. Lots of uncertainty at the moment with what's going on over in the Middle East. Yet the ASX 200, it's holding up. It's holding up well. In fact, on Friday we had a new all-time high for the ASX 200, and now that's a clear break above the all-time high from October. You can see the previous all-time high from October. Some new little all-time highs in the last few weeks, but then this clear-cut one on last week. I thought we might have seen a bit more consolidation before all-time highs, but there's been a strong return of momentum, largely due to resource stocks. We'll get to them in a moment. You can also see that dips have been being bought. Just looking over the last few weeks, you see the strong rally and then the shallow pullback. The dip was bought, rally, shallow pullback, dip was bought, another rally. And so those shallow and short-lived pullbacks. I thought this second one from about a week ago, that's the one I thought may have dragged out a little bit longer. Just let those moving averages catch up a bit more sideways chop perhaps. But that wasn't to be with the rally to all-time highs. The moving averages continue to move upwards. You can see the 50-day and the 100-day moving average both heading higher. So we can say that it's a clear case of a trending markets. Now, coming over to those materials, the materials index, which of course is where we find all the mining stocks. And so this is the ASX 200 materials. The big driver has been of this rally in the ASX 200 has, of course, been the mining stocks, in particular BHP, which has been trading strongly. We've been discussing this trend a lot over the last 8 or so months, really since prices got back above the moving averages. We've been talking about an emerging trend and then moving from emerging into a developed trend, and that continues to extend higher. And as I say, it remains one of those key drivers or probably does remain the key driver of the ASX 200 at this point. I want to stay long this trend. I want to stay on this trend in resources. There have been plenty of motion trader buy signals in this space over the last few months. this whole way up, had lots of signals to get in on this trend. And I think the key is to use a wide trailing stop to try and see off these bouts of volatility, which invariably occur in big trends, particularly in the mining sector. The wide trailing stop really helps see that volatility off and stay on the trend, and that's where you can make the money, when you can stay on the trend. I said last week I thought the markets were getting a bit. Well, I said last week I thought materials were getting a bit stretched, and maybe this period in here was going to be more of a sideways chop. Hence my thoughts on the ASX 200. But of course, that hasn't happened like that. Things have just moved higher without that greater consolidation. Like I said, I want to say in the trend, I'm a bit hesitant to be doing much buying at current levels. Prices can always get more stretched, but at some point they do. The moving averages do catch up. Prices do come back to the averages. So very much staying on it, but not just being a little careful about chasing stocks which might be well above their averages at this point. The other big part of the local market, of course, is financials. We discussed the likelihood of some consolidation last week, and that followed the quick move from below the averages to above the averages. And when you get that quick flip from below to above the averages, you often get a pullback in the consolidation. And this part's been playing out more along the lines of what we discussed. We have had that pullback towards the averages this week, and I think we could see financials continue to chop for a few weeks yet, just while those moving averages continue to move higher. But overall, I think the structure for this sector is positive. I think it provides another strong underpinning for the bullish trend in the ASX 200. One last component to have a quick look at is the equal weight, the ASX 200 equal weight. I like that prices have stabilised. I think that's a positive. There hasn't been any follow through selling whilst the price action's been below the moving averages, so that's positive there. But it's mostly been, this price action has mostly been below the moving averages, and even today it's just dipping back below the moving averages after marginally getting above them on Monday and a little on Friday. The equal weight it's been essentially range bound since October. So this whole period through here, it's really just been a big sideways range. And when you consider the strong gains we had off the April low, big rally, it's like really it's not that surprising when you get the pause and the consolidation following that type of rally. Really is quite typical. While I think this stability here is good, what I want to see the equal weight back above these moving averages. Again, the 50 and the 100-day moving averages. Consolidating below the averages at the moment, I want to see it back above, consolidating above the moving averages, become established above the moving averages, and that would bring it more in line with the ASX 200. Just quickly back to the ASX 200. As we discussed last week, I think the play here, it's staying long stocks, letting winning positions run. The ASX 200, it's got a bullish structure, and I think higher levels are likely in the coming months.
Yeah, as you say, as we've said many times in the past, all-time highs generally lead to more all-time highs, despite what everyone might think, and it seems to be going that way with the major index here. But the US markets, they're still going sideways, Jace.
Yeah, so the ASX, not the ASX, I should say the S&P 500 jumping across to the US. And another week in this tight consolidation for the S&P 500. In fact, Rog, this is one of the longest stretches of compressed price action on record. So the S&P 500, it has closed within 2.5% of its 50-day moving average. So that's the red line, is a 50-day moving average. It's closed within 2.5% of the 50-day moving average for the last 63 trading sessions in a row. And there are only a handful of other periods where you've got longer streaks where the price action has been so clung around the 50-day moving average. So what does that mean, and which way is this ultimately going to break? Well, ranges are common structures, and we often see them on charts. They often develop on the charts particularly after periods of strength, and they're that lull. They're a lull that often follows activity, and they're typically a holding pattern ahead of another period of momentum. The fact that this ranging period has lasted longer than most, I think it increases the significance of the eventual breakout, whenever that may come. Unfortunately, there's just no way to know for sure which way it's going to break. We can all have opinions on where we think it's going to go, but you can never be sure which way it's going to break. But breakouts from these compression patterns, and you can see how compressed the price action is, breakouts from these compression patterns often lead to strong momentum moves. And so this is something I think we want to watch closely. But another thing is, this also isn't your typical range. It gives the impression that it's really sleepy town in the US, that nothing much is going on, that it's been a really quiet market with little momentum or movement in either direction. And whilst that's true when you look at the S&P 500 index, when we look at things from a sector level, it's really quite different. So we'll start with tech. Let's go to the Nasdaq, and there's a lot of movement going on below the surface of the S&P 500. So we've been discussing this weakness. We've been discussing this weakness in the Nasdaq structure for the last few weeks. There's been some improvement this week with prices trying to stabilize and attempting to push higher, but it still needs to clear these moving averages. The price action, it's still below the moving averages, and it really needs to get back above the moving averages and re-establish above them. I think the low from a couple of weeks ago, so see this low here from the 17th of Feb, I think that's a key level. So far, prices are getting a foothold above that low, but if that low were to break, well then we get this sequence of lower lows, and then the November low then starts becoming into focus. So it's a key level to watch. Prices opened low last night, and then they closed up near their highs. So that's positive. That's why I say it looks like prices are trying to get a foothold here, but it's getting above the moving averages now, which is key. And if it does that, well, then that disengages the vulnerability we have while prices are below these moving averages. And this is where the US market becomes quite difficult, because the weakness we're seeing in tech and the Magnificent Seven, the big seven tech stocks, that's even gives a weaker structure than the Nasdaq. So it's difficult because we've got the weakness in tech, we've got sideways in the S&P 500, and then that's all being balanced by strength elsewhere. So have a look at this, and you can see where the strength is coming from. Like, look at the S&P 500 on an equal weight basis, whereas the S&P 500 it's really coiled up in a tight range. The S&P 500 equal weight, it's been trending higher, rising lows, rising highs. It's on the verge of a new all-time high right here and now. And again, shallow pullbacks and consolidations above rising moving averages. So that's all bullish price action. So we've got this situation where participation is expanding. So that means more and more stocks are in upward trends. You're seeing that through the equal weight. And then also you look at the Russell 2000, the small caps, we're seeing it across wider sections of the market. But then we've got a key segment of the market, Nasdaq, and also big tech specifically, looking like it's on the verge of a breakdown. So it's a really different sort of structure than we'd usually get. Quickly back to the S&P 500. The lack of momentum, it really does hide a lot of movement below the surface, as we were just discussing. But when I weigh it all up, I weigh up all the information, and there is a lot of conflicting information in there. My leaning is that the S&P 500 ultimately breaks to the top side. As it stands, the bull market remains intact. You can see that by the rising moving averages. So the bull market remains intact. I think the correct approach is to give this incumbent trend the benefit of the doubt. And importantly, Rog, I think it's about having a plan. And this is what a lot of people don't have. A lot of people don't have a plan. They're just looking They just want to know what to buy next, but it's having a plan to respond to the price action. And that means having an exit strategy for stocks that break down. Plenty of stocks in the US, particularly in tech, have broken down. Having an exit strategy there has been critical. And also having a buying strategy for stocks that break out. Should we get a breakout in the S&P 500 and various other individual stocks, having a plan, having a strategy for buying. Repeatable success, I think it's all about having that robust, good plan that you implement time and time again. And this is just another one of those times where I think a plan is just so important.
Yeah, of course, especially when we're getting mixed signals from the markets, as you sort of discussed there with those US markets planning ahead and ensuring you know where your exit is and where you could potentially enter is super important for all your holdings, obviously. All right, let's have a look at the Hong Kong market then. What's that looking like? Hong Kong.
Okay, quickly over to the Hang Seng. After looking so solid around the moving averages over the last couple of weeks, the Hang Seng's had a fairly sharp dip below the moving averages on Monday. This doesn't end the uptrend, so we've had this nice established uptrend for some time. So this dip below the 100-day moving average, it doesn't end the uptrend because you do get times. There can be times where prices do fall below the moving averages, but the uptrend remains in place. The key now is that prices quickly stabilize and then get back above the moving averages. And I think the time it takes to rally back above the moving averages will tell us a lot about the underlying strength of the market. So if buying at the dip continues to be dominant, then this should be a relatively short-lived pullback, should stabilize, get back above the moving averages. So the next week or two will be interesting. Does this start to quickly get a foothold or not? But I think at this point that underlying trend, I think it remains in place. Coming over to the Chinese market, we still have that vulnerable price action below the moving averages, but there are signs that prices are becoming resistant to lower levels. Just look at yesterday's price action. Prices opened low and then they closed near their high. So they broke below the early February low, didn't get follow through selling, but then closed up near their high. So it's signs that buying is present and prices are resistant to trading lower. I think to neutralize the near-term vulnerability, we need to see prices, as I've been saying with other markets and segments of markets, we need to see prices back above the moving averages. And that really does then neutralize the vulnerability. I still think this can resolve to the upside, but it's really about can prices get and maintain a foothold around current levels. That's I think that's the key to things in the Chinese market right now.
Yeah, it's certainly been going the way it's going for a while now, underneath those moving averages. But to see Hong Kong also heading towards that way as well, obviously you've still got this resolve going to the upside, Jace, which see which way it goes, right? So, all right. Let's have a look at some of the questions. We've got a few tickets to go through. Um, let's have a look at what before we get onto the tickers. I got one here from Roberto. It's more of a general one, maybe. What significance do you give to breakouts? And he's using an example. So MFG, which he doesn't know, but MFG today. What significance do you give to breakouts, Jace? It's probably
A lot. I think breakouts are highly useful, and like it depends what we define as a breakout. There can be different definitions of it. Like, we can be talking about a breakout from a trading range, so we can see a nice little range there. So you get a strong rally. After a strong rally, you get the pause. You get we're talking about earlier how a trading range is like a holding pattern after a strong move, and then you get a breakout. So that when prices broke out of this range, that was a sign that the momentum was returning to the upside. So it was a good entry point for a rally over the following few months. We can also define a breakout. It could be a yeah, it could involve like a rally off the moving averages, so prices breaking above like the one, their 1 week high, or their 1 month high, or whatnot. I look at prices breaking above a 70-day high. 70 is not a special number, but it's just I use that in as added confirmation with the moving averages crossing. So the moving averages cross, that's all good, but moving averages can cross. And just looking for an example which might be helpful. So like moving averages didn't quite cross here, but you can get times when the moving averages just marginally cross, but then prices just dip below them. Sometimes that can be within a ranging period. Prices are oscillating either side of the moving averages. So combining a moving average cross with a breakout to, say, a 3 month high, or something along those lines, it can give that added confirmation that prices are gaining momentum following a move above moving averages. So I think breakouts are an important thing. They help us see where the price momentum is going, and I want to be on the side of the price momentum, not betting against the momentum. I think the momentum is really, it's showing us, the momentum is the money trail. It's showing us where the money's flowing. So yeah, a very useful thing to keep an eye on.
Yeah, but in this example here, once again, where there's a breakout, but the moving averages don't confirm because they're heading the other way, right?
Well,
It's important just to not look at things in isolation, and,
yeah.
and
Look,
it's what I've mentioned all the time, right? So that's what I'm saying.
this is news related. It's I understand there could be some sort of a takeover involved or merger. I don't know the details, but it's very much news related. You could see prices were weak. They were below declining moving averages, and then one day they open, they gap higher and trade strongly, and the moving averages haven't had a chance to turn yet. So, like, this sort of move is not what I specialize in. Like, that's like, you don't. We don't know the future of announcements from a company, so it's not about catching those sort of moves. It's more about where prices are low, they move back to averages, they get above, moving averages cross, prices break higher. That's how a trend emerges. An emerging trend doesn't always develop into a long-lasting trend, as we saw with this case last year, but moving averages, price above moving averages, and breaking in new highs, that's the sign of emerging momentum. Gaps higher from long downtrends, news related. It's like, like they're not the moves that I'm looking for. You're not going to really get them. It's it's the other type where prices go from below averages to above. That's where we can see momentum and trends developing. And that's where we can sort of look for those asymmetric opportunities where we can risk a little to potentially make a lot. That's where the setups become, I think, tradable.
Yeah. And we'll get on. There's a few spin-off questions here which are related, right? So we'll just stick to them at this point, right? So Elisa's asked a good sort of question around, and we kind of answered this, having that plan and making sure you stick to the plan. But let's say there's this disruptive event, e.g., Iran, and what's going on over there now. Do you still sell on stop losses if it's a short-term reaction to the event, or do you wait to see if it was reactionary?
Look, we don't know that something's going to be a short-term event. Like, it could have been argued that the early stages of COVID was a bit of short-term panic about uncertainty, and it turned into a complete market rout where prices fell 30 or 40%. Some stocks even more. So there's a bit of danger in just sort of like trying to fade the news and go, oh well, it'll probably all just blow over. Maybe it does, maybe it doesn't. But if you've got a wide trailing stop, the whole idea of a wide trailing stop is you're giving yourself or giving your stocks breathing space, so they do have room for volatility. And like, I really need a good uptrend to talk about it. It's like, I know this isn't probably a great example either because it's such a strong uptrend. But if you've got a close stop, it's market noise is going to trigger close stops a lot more often than wide stops. So if I've got a wide stop and the market sells off, I'm not going to say, look, let's just see what happens for another week in case things settle down. Because what if? And this is always what I ask. It's like, what if it gets worse? What if the situation stabilizes, but my stock keeps selling off? It's like, the exit, your stop loss is your line in the sand. It's not your reconsidering point. It's like where you've when everything's calm and quiet, you've decided this is my plan. This is where I sell. This is my escape path if things start going bad. It's not your level where you start saying, well, okay, now I have another look at it, another think about it. It's like, well, that's not a plan then. That's just that's where you can end up. We've looked at these stocks in the last few weeks where stocks are down maybe 50 or 60%, and people are looking at them now going, what should I do? It's like, well, let's think about taking action before the damage becomes so bad that it really is a bit of a disaster. A wide trailing stop, lots of room, but that's your cutting point. And if things stabilize and stocks go back and rebound, that's okay. The ones that rebound don't ruin your portfolio. It's the ones that don't rebound that cause all the damage. So that's what the exit levels, the predetermined exit levels, are there to help you avoid.
Okay, thank you. And one more from Lloyd before we get on to our tickers here. Do you trade around dividends or try to execute trades outside of the vulnerability of dividends, I'm assuming?
Look, I don't really give much thought to the dividends. It's if I've got a breakout, I'll follow. Like, I don't look at the when I buy a stock, I'm not looking at a stock's dividend calendar to see, is there a dividend sometime soon? I've got a breakout, I'll buy the breakout, and then sometimes a few days later it goes ex-dividend, share price falls. That's okay. It then often stabilizes, and many trends then continue on to new highs. So I don't worry too much about the dividends. I collect them along the way. They're an added bonus, and they make a meaningful part of my overall return. But the biggest part of my returns come from staying on trends that run a long way, and not being too hung up around. I'm not being focused on the corporate calendar around dividend timing.
Okay. All right. Fantastic. Good responses there. Thanks, Jace. Let's get on to some tickers then. Hey, we're going to start off with the one that I can see here before it comes on chat on my computer. That's from SMW. Let's have a look at FLT, please. FLT.
Yeah, it really hasn't been working. This one, like, it gave the impression that it was there could have been an emerging trend in play. It did all the right things. Looked like it had stabilised below the moving averages, made its way back above. Averages crossed, prices broke higher. It had a series. It had rising lows, rising highs. If we were looking at it here, it would have been, well, yeah, look, this is an emerging trend. This looks good, but not every emerging trend continues into a larger trend, and some are going to reverse, and some are going to reverse abruptly, like this one has. It's quickly gone from above the moving averages to below. When that happens, we often get some sort of a rebound back. What the rebound back looks like will probably give us some information as well. If it's a sharp rebound back, there's buying of the dip there. But if it's just like an overlapped, choppy rebound, and that's, of course, if this happens, and this doesn't necessarily have to happen, but it's just what often happens. If it's a shallow rebound, it'll look like the rally's being sold and just weaken the structure further. I wouldn't be buying it at this point. If I'd bought into the momentum earlier on, and this has been a motion. This is a motion trader stock. I don't think it's hit a stop loss yet. No, actually, I think it either has or be very close to it. Looking where it would have triggered a signal, probably would have triggered a signal maybe in mid December. And look, this is why I always talk about many relatively small trades, because we've got to expect that a large portion of trends are just going to, they're just not going to deliver. So when they don't deliver, keep losses relatively contained. When they do deliver, let them run. This would be if it were in my portfolio, it'd be very close to leaving the portfolio if I hadn't already sold it. It could still recover, but it's kind of hoping at this stage that it recovers rather than showing us a good clean setup. It's the structure's not great here. Probably one that's going to be moved on.
All right, thank you. Next one is from Astro. Can we please have a look at? So I've just lost my screen here. I'll just go to the next one, the one I can see it. Roberto's MEI, please.
Yeah, this is look. We've got the trends in place. There's an uptrend in place. It's in a range at the moment. You can see the high from mid October. Then we've got the low from early December, and all the price action has been in between. So that's a range. So there's no immediate momentum with this, but it's one of those ones which could this break higher out of the range and continue rallying? That's the way I'd be. That's the way I'd be playing this if I had this. I'd continue holding it on the basis that this range has the potential to open or to break out to the upside at some point. And the benefit of the doubt goes to the upside because we've got these rising moving averages and prices mostly been above the moving averages. So not one I'd probably buy at the moment because no one knows how long a range can go for. This could still, continue back and forth, chopping within the range for several more months, maybe many more months. But yeah, certainly one I'd be happy to hold on to at this point. Wide trailing stop back below, like probably around the 200-day moving average below that. So giving it plenty of room to move about.
Okay, thank you. Next one's from Astro. EIQ, please.
Yeah, well, this one's stormed higher, and the trend is very much in place. Like here's an example of a nice breakout down here. So we're below the moving averages to above, and you can see like the strong rally, then a shallow consolidation, another strong rally, and then the consolidation. It does give most of the gains of that previous rally back, but it's slow and it's overlapping. And then you can see prices like you get a clear breakout on this day here on the 12th of January. So that would be a buy signal on that day. So that's a breakout. So you've got price action going sideways, starts to move higher, and then prices break above the previous high, rising moving averages. Risk return is positive. You have a stop back near the averages, see where it goes. In this case, it's gone a long way. Wide trailing stop helps you see off the volatility we're going to see along the way. So that means a trailing stop, which is at least back below the 100-day moving average. And that's the way I'd continue to play it. I'd continue to stay long, wide stop. It's depending on where we're in from. Say we've got that breakout there. It's now up. It's up nearly 100%. So I wouldn't be scaling out. I'd just be holding it. If I had this one, it's a sharp rally. It's going to probably go at some point. There's going to be like a larger consolidation. At some point, we're going to see it revisit the 50-day moving average. We just don't know whether it's going to be from is it getting ready to sort of like start coming back, or would it be a sideways move while the average catch up? We don't know, but one to hold on to if I had it at least. Wide trailing stop, but not buying up here because it's stretched above the moving averages. And if I were to buy it here, I'd be concerned that it comes back to the averages. And that is how big a drop is that? Well, it's 25% back to the averages. So then your stop's got to be further than that. So it's too big a stop loss to be buying it now. But yeah, very much I'd be happy holding it and risk a good portion of that profit to potentially stay on a much larger trend. And that's the part I think a lot of people get wrong. They don't want to risk a good portion of the profit, and that what encourages close stop losses. But I think we want to be really vigilant with our losses. We don't want to mess around with a losing stock, But when there's profit on the table, I'm happy to keep a lot of that profit on the table for the chance of a much larger profit. And I'm happy to risk giving a good portion of that back, because I know it's when I get some of those stocks which can go 200, 300, 400, 500%. The only way I can get them is because I've given them lots of room to move, and they're the ones that really make the outperformance in a portfolio. So, yeah, wide trailing stops, Rog. That's how we stay on these ones.
How patient can you be? Actually, I should tell. I remember going to a seminar once where someone asked, their $50, and it was along the lines of, would you take this today or would you wait, a few months to double, triple that? And a lot of people would just take it today, right? Because they don't know what's going to happen in a few months' time, right? But I guess with and psychology is the instant gratification as well of taking the profits on the table. We're all for instant gratification this day and age, but I think in the game that we're playing and what we've been teaching a lot of the times, and I've certainly found this in my portfolio the last few years, is that the least I play with my portfolio, the more I've been able to gain over the last couple of years. And I'm happy not touching my portfolio and trying to be like a day trader, so to speak, because I can't afford to do that, as in I don't have the time to do that. I'm certainly not a day trader, but an active investor is someone who can manage their portfolio and have just as much patience, to hold that profit, and see where it can go, right? So,
Yeah,
yeah.
it's so interesting. It's like there's all sorts of studies on this, and humans, we're just wired that we like to shut down uncertainty. We don't like uncertainty. Uncertainty is destabilizing. People would prefer a certain sure thing, a certain smaller sure thing than a larger reward, but which is uncertain. But the problem it is we have with the stock market is the whole game is the whole thing's systems built around uncertainty. So I think it's hard to come into an uncertain environment wanting to use strategies for certainty. It's like, if we want to do individual stocks, we want to do the stock market, we've just got to become accepting that we've got to get into that uncertain environment and be able to cope with that. And I think the best way to cope with it is by having that rules-based structure. If you're just looking at your share prices each day and going, okay, I'm up 15%. Okay, great, I'm out. There's no real structure around that. I think it's going to be very hard to go forward over time. But if you've got that structure, you've got that consistent, repeatable, rules-based structure, well, then you put yourself in the game, and you're going to be able to see off some uncomfortable periods, because you've got a plan around your selling, and you're going to have a plan around your buying. And it doesn't mean every post is going to be a winner, but it means we're going to be able to hopefully contain our losses and keep them manageable, and have the confidence to let our best positions be the best they can, and not be jumping out early and looking at them 12 months later going, if only I'd held on, because we've got a plan to hold on if they're doing the right thing.
Mm. Yeah, exactly. Well said. All right, let's get on to the next one from Tony. I'd like to hear your thoughts on oil. Obviously, it's a hot topic at the moment, and particularly WOR, please. If you wanted to look at the oil chart as well, we can do that.
Yeah, just quickly, because I cover commodities in the Friday strategy session. So if you like going through the commodities, come over to the Friday strategy session and we go through it in depth then. So I'll just briefly touch on it here. It's had these declining moving averages for some time. We've gone from below the averages to above. I've been talking about this building structure for the last few weeks, so it's no surprise that we see it up at higher levels now. It's a breakout. It's an emerging trend. Let's see where it goes. Been talking about oil stocks to be long in the last few weeks as well, and we're seeing that strength come through. So I think it's an environment to, if we're on oil stocks, I want to stay on them and see where this goes. Yes, it could just be situation related, and prices spike higher and they crash back down in a week or two, but we don't know. We've got the makings of a trend. Let's give it the benefit of the doubt. Let's see where it goes. And WOR. Well, it's The price action is it's doing the opposite to what the oil price is doing. Now, Worley doesn't, as I understand, is more involved with. I think it's more involved with the infrastructure around oil rather than actually drilling for it. But I don't know. I don't know the background of the company. Um, this is it's not a stock I'd want to be in at this point in time. It looked like maybe it was trying to turn higher in September, October, but then it's just crashed back down below the moving averages again and really spent its time consolidating below declining averages. It's a weak structure, um, so it's not. Yeah, it's not the stock I'd want to have in my portfolio at this point. Certainly wouldn't want to be trying to pick up a bargain in it at the moment because the risk for me, as I see it, the risk is that it continues to come lower. It's in a downtrend. We don't have any signs on the table at the moment of a turnaround. I've got to leave this one alone. It's got to get back above the moving averages, and that's probably going to take a bit of time from here.
All right, thank you. Let's have a look at Jen's. Thanks again, Jen. Let's have a look at VMM. VMM. M for Mary, two M's. Two M's.
LM. Well, that's a nice trend which is running. It's been a tough stock. It would have been hard to have seen off that large correction back in October. And this is the thing with wide trailing stops. It doesn't guarantee you're going to stay on board. This is like, what's that? 60% pullback. Yeah, wide trailing stop's not going to. Well, it's exceptionally wide, but then it can get too wide. Wide trailing stop's probably not going to see off that. And this is the thing, like no exit strategy is going to give you a perfect outcome on every situation. But it's re-emerged into its upward trend. If I had this in my portfolio now, I'd be holding it. I like the structure over the last few months where we've got strong rallies, shallow pullback, strong rally, shallow pullback, another strong rally. So I'd be going with this trend. It is stretched above the averages. I'm probably not a buyer here. Let's see what the next consolidation looks like. Let's see whether the averages can catch up a bit. But I'd certainly be holding on if it were in my portfolio.
All right, thank you. Next one's from Neki. Let's have a look at Santos.
So we've gone from below to above the averages, had the pullback. You can see how it's re-established above the averages with a relatively shallow pullback over the last few weeks. Averages are now crossed, and now we're broken out to a new high. So it's broken above these series of highs since January. I'd be holding it if I had it in my portfolio. It's still like when we step back and look at it overall, it is still like you can carry that across that resistance band. You can see there's plenty of overhead resistance. There was potential takeover activity around it last year. You can see the gap high, but then the takeover was pulled, and then you can see that's where the price dropped back. It's not a stock that's in a upward trend at the moment. It's one which, like, could this develop into something? It certainly could. So I'd be happy to hold it in my portfolio if I'd recently bought it as prices have sort of like come back above the averages, and see whether it can develop. But it hasn't been a strong trending stock for some time. That doesn't mean it can't in the future, but the strong trend's not there at the moment. But the potential for this latest price action to develop into something, well, it's certainly there. I prefer Woodside to Santos, but there's enough here to say it's worthy of giving it some patience and some time and seeing whether this can develop into something.
All right, thank you. Next one's from the Chief. Let's have a look at DBI.
Yeah, this has been a surprisingly strong trend. I remember this first appearing in the Motion Trader Signals. It was back in, I think it was back in 2022. was back like it was only a relatively recent listing when it first appeared, and it just seemed like a unexciting infrastructure stock. And I remember thinking this probably isn't going to go too far. It's just infrastructure is going to be a bit of a dividend. It'll just sort of like, yeah, it's broken high, but it'll probably just rally a bit, maybe, but not do anything spectacular. But couldn't have been any more wrong. It's turned into a terrific trend in a dividend paying low volatility stock. So it just goes to show, like, be open minded with a trend, because some trends won't do much, but some, and it's not always the ones. A lot of people like to look at their small mining stocks, but even stocks which you wouldn't think would necessarily be leading the world beta trends can do some pretty impressive stuff. Case in point, we're looking at. If I was holding this, I'd continue to be holding it. A wide trailing stop has seen off all these pullbacks along the way. It's still on the motion trader portfolio. I'd probably not be a buyer at this point in time, simply because it's just rallied to a new high and it's quickly come back to the averages. So maybe there's some more consolidation coming in the near term. It might have just gotten a little bit ahead of itself in that most recent spike higher. But look, this trend remains in place. If prices stabilise around the averages over the next few weeks, it might set up a platform for a new entry. So certainly a hold, and yeah, keep an eye on it for a potential entry point.
Oh, fantastic. The next one is from Matt. Max, hello, how are you going? It's actually from Sydney. PME, please. PME.
No, it's just like, this is what we were talking about earlier with, like, just having that plan for an exit strategy, and this is one which has completely come apart. And it's like, how far are we down from the high now? It's down nearly 70%. This was a motion trader stock. I guess it would have triggered a motion trader signal somewhere early to mid last year. Trend ran for a bit, then it stalled back to the moving averages, then crossed down beneath them and consolidating below them, selling at the rally back to the moving averages, and then the motion trader stop was taken out. I'm not sure exactly where, but somewhere probably around late last year, and this is why we want to just have that. Like, I think the question earlier was, should we, when there's a bit of an event like the what's happening in the Middle East, should we just uh, give have our stops, but then maybe just give them a bit more time just in case things settle down. This is why I don't like to give a stop a bit more time. It's like, stop's triggered. Doesn't matter why it's triggered. It's triggered. There's the plan is to sell it. So it probably should be moved on. I don't want to then reconsider it and move the stop a bit lower, because this is a risk. This is a risk. This is a what if. What if it keeps falling? And PME, it's kept falling. I wouldn't have it in my portfolio now. If someone's still holding it, this is where it gets hard, because it has fallen so far. And this is why it psychologically becomes so hard as well, because people don't want to sell it now, because they say it's fallen so far, it can't go much lower. Maybe that's right. Maybe it is going to base here and then start to recover. So people become resistant to selling it. But there's still a problem, because even though it's down 70%, it can still fall 50% from here, or 70% from here, or even 100% from here. Probably doesn't happen, but anything can happen. So probably the aim is not to get into this situation in the first place. So then you're not going to have to, you're not sitting here down 70% going, now what will I do? Definitely wouldn't be buying it at this point. I'm not interested. It could have a rebound back towards the moving averages, but I don't want to try and preempt that, and I don't want to try and trade that. I'd just leave it to the side. And this is a stock in a clear-cut downtrend, and downtrends are dangerous. They destroy capital. So I think it's one to be left alone.
Yeah, I don't know if I should ask this or not, Jax, because we could be opening up a can of worm. But I remember Pro Medicus being quite the news got the big stock a few years ago, and we were all talking about this company Pro Medicus, right? And obviously it's been paying a pretty good dividend, I guess. I'm not 100% sure, but I think it was a dividend stock, right? So, but at what point do you say it's a good company versus sticking to your system, right? So, and are you starting to give back all those dividends that you've received over the years in the loss of capital now?
Yeah, it's like I guess this is also where we've got to differentiate between what's our time frame? Are we long term or are we medium term? I'm medium term. Motion trader is medium term active investing. It's about looking for what's working and going with it, going with the flow of what's working until it's not working, and then jumping ship and going on to something else. So this was just looking at the price action. This would have been a motion trader signal in probably around here in September 2022. So we can just break it down. Like, look, it's interesting because it's like it shows how a mega trend can form. Prices went from below the moving averages to above. They started to establish moving averages crossed. And then I used that 70-day high. So the moving averages crossed, but it wasn't an instant buy. The 70-day high probably came in September 2022. So early September. This is probably our buy point. Wide initial stops. It didn't initially run. It backed off. So I get people taking a 2-week trial and they say, "Oh, I followed your signal and the stock fell." It's like, well, yeah, they'll do that sometimes. Maybe the market fell that week as well. I don't know. But yeah, it's not about precision. It's about identifying the underlying momentum. That's the key factor. So we identified the underlying momentum, gave it plenty of room to initially move around. So it did come back to the averages. It stabilised again. It took from a September entry. It took a couple of months to then convincingly make new highs. Still wasn't a clear-cut run. There's more retesting of the averages, so it would have taken it probably back below the entry point for a little bit. Then it got going. Again, it's not going up week in, week out. It's not going in, month out. So people get frustrated and they go, "Oh, it's not working. I'm going to sell." Wide trailing stop. Could see this off. That's a completely survivable sideways consolidation. And you can just see this trend extends. Sharp pullback, wide trailing stop, could see that off. It's how much was that? That was 23%, completely survivable with a wide trailing stop. But a lot of people would see the headline down 20% or 15% in a day and go, "I'm out. I've got to protect my capital." Mistake. Give it room to move because sometimes and often they recover, as this one did. Continues on, same story. I've just been going on. Then the structure starts to change here. It's below the moving averages. It's consolidating below the moving averages. Starts to come back. It's come back too far. Trailing stop's going to go off. Let's just get out, protect capital, take a great profit. Multi 100% profit. It starts to rebound. People get frustrated when they say, "Oh, mate, I shouldn't have sold. The trailing stop got it wrong." But we've got to give it things lots of room to move, but we've got to have a line in the sand as well. Turned out that it did rally a bit more, but then we had the final turn was a bit higher, and again the structure changes, sell the rally, want to be out of this stock now, and then the whole thing comes apart. So I'm sure there would have been plenty of good media around it up near its highs about how it's going to be, great things are going to happen, but that's the nature of trends. No one's really talking about a lot of these trends at the bottom. A lot of people are talking about them at the top. The idea is, with momentum, we're using momentum to identify what's starting to work now, and maybe when a lot of people aren't thinking about it, giving it plenty of room and time and seeing what it does. Some stocks will go like PME and do great things, but they're also probably going to have a turning point as well. And that's where we want to jump out. So yeah. Yeah, it's an interesting one. It's an interesting case study, Rog, about how trends can evolve and how profits can be maximized with good strategy.
Yeah. All right. Let's good chat. Let's have a look at the Nasdaq stock in LWLG. LWLG.
Yeah, this is an interesting stock. Like Yeah, nice building trend into towards late last year. It's had that pullback, but look at the pullback. It looks like a corrective like pullback. So if we use the low as a reference point, the low from May last year, strong rally, proportional looking pullback. You could even put some Fibonacci's on that and probably find that it comes right back into the Fibonacci zone, starting to rally off that. Oscillated either side of the moving averages. Now it's back above the averages with a strong rally. Averages are turning. Um, it's kind of right around. This is kind of where the buy signal occurs now. So the averages have just crossed. That's probably like a 70-day high. Again, 70 is not magic. Someone might use a 50-day or a 60-day or an 80-day, whatever it may be, 1 month or 2 month, it's hitting new highs. That's the point. So the averages have crossed and it's hitting new highs. It probably could be bought at current levels. It could have a stop back down. Oh, it's a bit far. Yeah, probably a 25% stop back towards the moving averages. Um, I think it's probably could be a buy now, and see whether this continues to run. Alternatively, see whether there's a pause and a consolidation of that initial run off the recent low. Maybe there's a pause and a consolidation while the moving averages continue to turn. There could be a secondary break. That could be a buying point. But one I'd certainly be keen to potentially get involved with.
Okay, thank you. Langer, let's have a look at NEC, please.
No, downtrend. It's been a tricky one because it did have the basis of an emerging uptrend. Then we've got this big nasty gap lower in September, and now it's breaking to new lows. So for me, this would have been an exit in September on the gap down. It's not the sort of one I would have hung around for. Maybe like hold in for could there be a bit of a rebound back towards the averages? But I wouldn't have been mucking around too much with that. I would have been letting it go, and it's making new lows now. It's like no reason to get involved with this stock. I'd be, if it were in my portfolio and I'd been holding and hoping for a rebound, this break to new lows would just be the final nail for me. I'd be going, okay, I need to just clear this out. It's not working. And if it does stabilise some point soon and break back higher, well, great, we can have another look at it. But at the moment, the risk is it continues to trend lower.
Yeah, and once again, a point with this is that obviously, then you've mentioned around is dividends. It's paying a dividend on the 9th of March. Is it a safe stock to look to hold long term? We can't answer that. Obviously, it depends on your goals in your strategy and your portfolio. Are you holding this for dividends or are you holding it for capital growth? I think that's what you've got to question yourself as well, because we can't answer that for you. We're certainly looking at it from a trending perspective, and this doesn't look like it's trending at the moment. We're not taking into account anything around dividends or return on that, right? So something you'll have to do your diligence around. Next one is Lloyd. Let's have a look at SIQ, please. SIQ.
It's really hasn't done a lot for a while. It's had some trend starts which really haven't gone on with it, and it's had a downward bias through 24, and then last year it kind of had a bit of a. It's really not giving us a great deal. If anything, we could say there's a bit of a range going on at the moment. Um, it's got a slight upward bias and it's in a range. So if it broke to the top side of this range, it's like maybe we could go with that and give it, see whether something can develop. Um, like we saw with Dalrymple, DBI earlier on, trends that you don't think anything exciting is going to happen, big trends can emerge. So just because this hasn't done much for a while doesn't mean that's always going to be the case. There was a time when this was a terrific trending stock. So it's never write a stock off. when you got the potential of an emerging trend. I'd say, look, at the moment we're a bit range bound. If I had in my portfolio, sure, I could keep it there. If we start breaking below the February low, well, then it's really not looking like anything's happening in the near term then. But if it can break out of this range, well, then maybe we've got the basis of some momentum starting to build. So it's an interesting one to watch, but we just don't have that momentum trigger at the moment. It could continue to just oscillate within this range for a while, or a breakout could be closer to hand. So I think the breakout to the upside is the key. If we get that breakout, well, then let's consider going with the momentum. Until then, probably can be patient.
All right, thank you. Next one's from Aka. Let's have a look at FRS, please.
Terrific trend, continues to trend higher. The usual with this, it's like wide trailing stop, let it keep running. The reason we've potentially got a large profit in this is because we've been patient with our profits. We haven't been quick to run in and take them. And but then you've got to have those wide stops as well. Like, you can have some significant pullbacks in these stocks on the way. That was a 48% stop. Be interesting. Let's put on a wide trailing stop and see what it gives us. See whether that was survivable or not. So this is ATR based. So this is just a generic trading view. ATR stop. So ATR is average true range, or basically every average trading range. I'm using a multiple of 10, and we're assuming that where's our buy signal for this? That's where the moving averages cross. The buy signal for me would have been right here on the 14th of April, where it makes a 70-day high. So let's just bring our stop across to there. And you can see how the wide trailing stop has managed this. It's still in there, still giving it a lot of room to move. But if the volatility if it stops being so volatile and just starts going into a narrower range, the trailing stop will continue to increase. This is the way I'd play it. If I was in from where that signal first occurred, and where are we now? It's now up like over 1,600%. It's interesting. That's what's possible. You do trends. You keep your downside relatively low. Let your profits run. Wide trailing stop to see off pullbacks. This is entirely possible. Look, I would have been scaling out of this one along the way. I wouldn't have my full position still, and so I wouldn't be up 1,600% on the whole lot. But I'd still have a core position. But I would have I would have taken some profits like from about 300 or 400% onwards. I would have maybe I would have sold a third and then run it a bit longer and maybe sell another quarter or something. I don't know what it'd be exactly, but I think it's all like it. Also, if you have if you have a single position that you never sell, it does introduce the potential for a lot of portfolio volatility should something unpleasant happen. And unpleasant stuff does happen sometimes. Like I don't know where this one's based, but sometimes you get these stocks which they go up a huge amount, but they're based in some African country, and the government decides to nationalise the mine, and the stock goes to zero, gets suspended, never comes back on. I'm not saying that's going to happen here by any stretch. It's just an example of why it can be good when you've got a great profit, particularly in a low price stock which has come good. Just always be aware of its situation. Where's it based? What's it doing? Because I have seen this before. Great gains, you can't even sell in the end because the stock never gets suspended for good. I'm not suggesting this is going to happen here, but just why it can be good to lock in, to take some money off the table from these giant trends.
All right, thank you. Hi, Ryan. Let's have a look at ADN, please.
Just not much going on. Look, there's not much here. There's no momentum either way. It's been a little bit of a build from the bottom from the start of last year, but the strong rally, then it gets completely sold. Strong rally gets sold. It's not holding onto its rallies. We want to be optimistic, we could say, look, there's a range. There's a bit of a range going on. If it can hold the lower end of the range and start to break higher. The key is, can it break higher? It's not one for me, but that's kind of like how I'd look at this at the moment. It doesn't have momentum. The rallies have been sold into so far, but if it can stabilise on this range, get above the averages, maybe break out of the range, you never know. Things can happen, but it's not one I'd be actively looking at just at the moment.
All right, thank you. Hi, Silky. Let's have a look at HMY, please.
Upward trend. This is a motion trader stock. It's been trending nicely. I think the initial signal was back down here in February last year. You can see the averages cross below to above the averages. Averages cross, breaks to a new 70-day high. Give it room to move around. See off initial pullback, and it's all going well. It's sideways range at the moment. It's in this. You can just quickly sketch that in. Thereabouts, you can see it's compressed into a range. Keys can it break to the upside, re-engage the momentum. If I had it, I'd continue holding it. I had no problem holding this. Trailing stop. Motion trader's got a calculated level. It's going to be somewhere back down towards 60 somewhere. I'd imagine just by eye. It's trends in place. Probably wouldn't be rushing to buy it just yet. If I was interested in buying it, I'd probably want to buy a breakout above these this little cluster of highs, which is not too far below at the moment. As I say, one to hold.
All right, thank you. This one's from Adonis. Thoughts on AG1? A1G. Sorry, it's a gold play, and the buying back into gold, given that this is seasonally a weaker time of the year, I would favour waiting for a pullback to the 5,100 level or a breakout of the 5,600. That's we'll stick with A1G first.
Yes, we're talking about the gold price. I cover gold in great detail on Friday strategy sessions, so come across to those. Anyone wants to be across all the what I'm thinking around gold. With A1G, it's just in an uptrend. It's been so for some time. Wide trailing stop has seen off all of these pullbacks along the way, and if it was in my portfolio, I'd be continuing to hold it. I probably wouldn't be buying at these levels because it is stretched. Like, yes, it can get more stretched, but at some point, as we talk about, things always come back to the moving averages, presuming they continue to trade. That is, I'd be letting it run, but I probably wouldn't be chasing gold stocks higher at this point. Very happy to hold gold stocks that are running, but probably not chasing them. So there's a difference between happy holding and not chasing. Now I talk about that in the Friday strategy sessions.
All right, thank you. Let's look at Xtraders, which is EDV, please.
Yeah, this is an interesting one. So it's been in this big downward trend, but just in recent times it's stabilised. It's gotten back above the averages. Averages have just started to turn higher, and prices have just broken to new 70-day highs yesterday. Open today, traded up and just coming back down again now. But look, I think there's the potential of developing momentum here. It's a dividend paying stock. I think it's around. I think it's just under a 5% dividend. I had a look on the ASX website yesterday, so I actually have this one in mind. Look, where it goes, I don't know, but I think there's you can see there's a definite swing in the momentum from down to stable to breaking upwards. I'd be happy to give this one a go at current levels. I could have a stop, back below the moving averages. If if it stabilises here and then turns higher again, see where it goes. But if it comes back, we can keep risk relatively tight. But if it runs, it could be a good trend. Very interesting stock to I think consider at current levels.
All right, thank you. One from Hubert. RSG.
Yeah, look, just like A1G, upward trends in place. I'd be letting it run, probably not chasing it. But the money's been made in this since. So yeah, the motion trader signal would have been back in May last year, and the money's been made by letting it run wide trailing stop, and yeah, that continues to be the play. When something's working, let it keep working until it gives you a reason to say, okay, this is no longer working, and that's what the wide trailing stops for. So at this point, this is definitely one I'd be comfortable keeping in my portfolio and letting run, see where it goes.
All right, thank you. We'll finish off with this stock, IMB from Daisy, please.
Yeah, this was a motion trader exit just yesterday. So we got a signal. We would have got a signal on this one. You can see it's. I spent a bit of time going sideways along the moving averages. I think the buy signal must have been in around late December when prices got above the averages. The averages have crossed. Prices are breaking above those previous highs. So we've got a breakout, but it doesn't stick. It then starts to come back. The initial pullback is okay, but then it gathered steam back to the moving averages. It's still okay, but it's got to get a foothold. Got to hold the line, and but didn't hold the line. Instead, it gave way, and that's what the stop loss is there for, to say, okay, enough's enough. Now's the time to square it up and look elsewhere. It's quickly gone from above to below. So maybe there's a bit of a bounce, but I wouldn't be messing around with it. I'd just say, look, it hasn't worked, and I'd move it on. The problem with waiting for a rebound, if you don't have the skills to like read the chart and try and pick up the nuances in the price action, is that when do you, if you don't get the rebound, when do you cut it? And the problem, I think, for some people would be if they tried to sell it in a rebound and prices just kept ebbing away and they didn't sell it, the risk is then we're down significantly at some point in the months ahead. Maybe this is it and it rebounds and goes to new highs, but I'm now concerned. I'm in capital preservation mode at the moment. If I was in this stock, and I'd be looking to get out, confine my losses to a relatively small amount of overall capital, and not worry about it and move on to the next idea. It's like we're going to get these trends that fail. That's part of the process. Trends will fail. The key is don't lose too much on them so we can then move our capital into another setup where the potential for upside exists. And if it works, great, let it keep working until it doesn't. If it doesn't work, do the same thing. Confine the losses to a relatively small amount, move on to the next idea. And it's a process of trial and error, following a process. And ultimately that leads to the stocks which can run a long way. But we've got to minimize our losses when they don't work out, and don't get discouraged by it. Plenty of trends don't work out. It's like there's 2,000 odd stocks in the stock market, and most of them don't do anything special every year. So we're just looking for the ones which can really provide good results, but we're going to get the ones that don't work out along the way.
Yeah. All right. Thank you for that. We might just finish off here with a general question around stop loss. There have been some great conversations and some great examples and tickers we've used today. So we're going to finish off with this general question around with Max's here. Would you use two approaches for setting stop losses? Short term and long term. I assume the long term one would be the ATR one, but how about the short term?
I wonder, like, are we talking about for the initial entry? Uh, like, like I think the initial entry stop can be. There are different ways to do the initial entry. So, like for a stock like such, so let's say this is our motion trader entry. Motion trader would have had a standard 25% trailing stop. So there's our 25% stop. Now, if someone understands their price action a bit, they might say, well, look, I don't, I want to. I understand wide trailing stops, but I want to have a tighter initial stop. I might just give it back to below the 50-day moving average and I'll have a 12% stop. And that might be fine. But if the stock starts to run and we move into an uptrend, I think there's no substitute for the wide trailing stop. Then it's like, well, it's okay to finish, I think, your initial stop. And bear in mind that you can have a tighter initial stop. You can get stopped out on your tight stop, and the wider motion trader initial stop would have kept you in. So situations are going to happen, but that's okay. You might be happy with that, and that can be completely manageable. But I think if you want to get those larger potential trends, you've got to then have the wide stop. You can't be using 10% and 15% or 20% stops if you want to be getting big medium term trends, because you're going to get these pullbacks, which are going to trigger those closer stops. I think closer stops are inconsistent with getting big medium term trends, because you can't get over the hurdles of the pullback. You run into the hurdles and you're out. But they can be a variation of your initial stop if if you know your price action well enough to set an effective closer initial stop.
All right, thank you. I hope that answered your question, Max. All right, I think that will do for today. Thanks for that, Jace. Had some great conversations once again. We appreciate all your time on the other side of the line. Thanks for coming and joining us. We will see you again next week, same time, Tuesday. So hopefully we'll see you back then. Thanks, Jace.
Thanks, Rog. That was fun as always. Thanks, viewers, for coming and joining us. And maybe catch you on the Friday session. Otherwise, next week.
Exactly. So don't forget Selfwealth. There's a link down below, and you can get 10 free trades if you are not a member already. And then there's the link for Jason's trial as well down below. All right. So once again, thank you very much, and we will see you again next week. Take care. Bye.